So, Gerard, what do you think is being signaled here? I mean, if I look at a chart of the XLF as an example, right, it was at its lows for this year, at least, back in March. Did that then presage the terminal rate already being reached? Or, do we still have to go through a bit of a process here?
Julie, it's a really good question. And if you look at some of the more bank-specific ETFs, they bottomed in May when First Republic failed. But that's been the monkey wrench or the curveball in the equation this year, is the three bank failures that we all witnessed. Of course, Silicon Valley started it in March with Signature Bank and then followed by First Republic. And so we kind of threw it off kilter based upon those failures. But if we now have those failures behind us, we don't expect any other types of failures like that. And so if the Fed really is at terminal rate right now, the stocks are bottoming out. But here's the risk. The risk is they're not able to get inflation under control. And we're now sitting in March of 24, and they're still staring at a 4 to 5% inflation rate. And they have to take the Fed funds rate up north of 7% to bring it under control. That's the bear case for the banks. Now, that's not a consensus call, and we're not calling for that. But that's the long tail risk for the banks today.
What about the economy, Gerard? I'm interested. There's a lot of smart CEOs and economists. They come on Yahoo Finance and they'll say, listen, they think the Fed is going to stick this soft landing. Others have come on and said, reiterated that's actually pretty rare and tricky. But if there is a soft landing, Gerard, what would that mean for the stocks in your universe? What would it mean for the bank stocks in 2024?
Josh, it's the $64,000 question, and it is the critical question because banks are products of the economy. And it's always easy to say the current period is the most challenging, but the cross currents on the economy today are unprecedented. And the reason being is what they did to pull us out of the pandemic. As we all know, the Fed's balance sheet went from $4 trillion to almost $9 trillion during the pandemic. Our U.S. government's fiscal spending, in addition to the regular spending, they gave out almost $6 trillion of payments. So that stimulus to the economy has been really the big difference between prior periods. But if they are able to thread the needle on a soft landing, like Greenspan did in 1994-95, you go back to that period, once again, rates went up from 3 to 6% from February of 94 to February of 95. 1994 was a wreck for the bond market. Orange County, California, filed bankruptcy. You had the Mexico peso crisis. It was really bad. Stocks sold off hard, the bank stocks, in the second half of 94. But once it became apparent in 95 that we had what they called back then the Goldilocks economy or the soft landing, banks were up 55% in 95, best single sector in the market. And so next year, if we get the terminal rate now and a soft landing, bank stocks are going to be big winners next year because the relative valuations today are the lowest we've seen in decades.